On Thursday, the Senate Committee on Banking, Housing, and Urban Affairs met to address deposit insurance reform. After the failure of Silicon Valley Bank and Signature Bank in spring, regulators were prompted to cover billions in customer deposits that hadn't been insured by the banks. Our next guest was at those Senate hearings, noting that the committee chair, Sherrod Brown, framed the issue as a matter of community banking competitiveness. Punchbowl News financial services reporter and author of The Vault, Punchbowl News' new newsletter, Brendan Pedersen. He's joining us now to discuss more. So what kind of stood out to you here, and is there actually going to be reform on deposit insurance?
Thanks for having me, Julie. What stood out to me more than anything is that Democrats have a lot of, shall we say, disparate ideas on what to do now that we're about 4 months out from the initial collapse of Silicon Valley Bank. You have to remember that deposit insurance really took on a central role during the mini banking crisis of the spring. Regulators had to step in and protect a whole lot of uninsured deposits that they normally wouldn't, but they were worried about the health of the broader financial system. And whenever that happens, lawmakers say, maybe we should reopen this law because you'll recall the FDIC's insurance cap has been set at $250,000 per account holder since 2010. It hasn't changed in a really long time. But listening to Democrats yesterday, you did not hear much cohesion of ideas. Sherrod Brown, yes, did talk about community banks and said, look, if we don't raise the threshold for deposit insurance, the big guys, the biggest banks that we know regulators will not fail or not allow to fail, are going to suck up all the deposits if people are worried about the safety of their banks. But other lawmakers are all over the place on this. We heard Senator Bob Menendez says he was actually worried that if we raise the deposit insurance cap, smaller banks might be hurt because that's fewer accounts being spread across the financial system to get that full coverage. So this is not fertile ground for broad legislative reform, even on something as technical as deposit insurance reform, because financial services legislation is really tough. You need that cohesion. And I asked Sherrod Brown after the hearing, do you think you have a path to consensus? And he told me he doesn't see it right now.
I mean, with that in mind, then, say they did perhaps raise that ceiling over 250,000 debt. What does that mean in terms of responsibility of banks? Can they then afford to turn, more of a blind eye if they know that even more will still be protected?
That's a great question. There is a certain amount of, and this is something that Tim Scott of South Carolina brought up a number of times yesterday. He said that there is a cost to raising the deposit insurance cap. Now, there's different ways to interpret that. On the one hand, the higher the government's threshold for deposit insurance is, the more money that we would expect banks to have to pay the FDIC for the privilege of deposit insurance. Because remember, the deposit insurance fund is actually funded by bank assessment fees. They give a certain percentage of their assets every year, or every couple quarters, I should say, to actually fund that fund. So if there was more coverage, they would presumably have to pay more. That would probably be balanced out by a little bit more risk taking, but it's really hard to generalize on that front. But people worry about that. Moral hazard is a huge concern for bank regulators, right? You really don't want to take off the speed limits when it comes to banking. That's when we get into trouble.
And were there any proposals that seem to be getting more support than others, whether it's the camp that says leave it like it is, or the camp that says no, we have to change this and increase this deposit insurance? Where did it seem like there was any support gathering?
I'll say this. There is a thread from the Silicon Valley Bank collapse specifically that has carried through and has some bipartisan energy. It's just hard for me to see this as a standalone issue. But this has to do with payroll, right? One of the huge issues with Silicon Valley Bank when it collapsed is it was holding a lot of money for a lot of important companies when it came to making payroll. And the way payroll often works at a business in the United States is you might suddenly drop $10 million into a single account that's going to go out the next day. So you don't really need deposit insurance for that account because you're assuming the bank isn't going to fail in that 24-hour period. But in the case of Silicon Valley Bank, that's kind of what happened. And so there's some conversations about just putting payroll accounts into their own category and letting the deposit insurance fund basically cover that indefinitely, right? Only because it is so disruptive for employees to suddenly not have their pay. And it's so unlikely that a bank would fail while that money is effectively in escrow that it's a kind of a lower hanging fruit. We heard Senator J.D. Vance talk about that yesterday during the deposit insurance hearing. He has a bill that would do something to that effect. I'm not sure if that bill has actual bipartisan buy-in specifically, but I've heard that from a number of lawmakers, right? This is sort of it's kind of a Band-Aid fix, but it is a palatable Band-Aid. And that is often what it takes for Congress to pick up legislation.
I mean, but low-hanging fruit and how, Brennan? I mean, obviously that's important, but it's pretty minor in the grand scheme of things in terms of if you're looking at systemic risks in the system. I'm curious about the parallels between this time and, say, the financial crisis or other times that we have seen financial legislation get through, reform legislation get through, in terms of a crisis happening and then action happening and how long it takes, right? So are there any sort of lessons to be taken away or parallels to be drawn?
The problem with this mini financial crisis is that the damage at the end of the day was not all that bad. And I say that like it's a problem. I guess it's probably a good thing that didn't happen. But it remains it should be said that ultimately the system kind of worked, right? A lot of people were grumpy about the way in which the Biden administration invoked the systemic risk exemption to cover those deposits. But ultimately, and regulators since, like Janet Yellen and Michael Barr at the Fed, have made very clear that they believe invoking that systemic risk exemption was A, exactly what the systemic risk exemption is for. It's why it still exists in law. And B, it worked. Like it prevented a calamity, a collapse. And so when you think about that, you can make the argument that, sure, maybe deposit insurance limits are due for a little bit of a raise, but the system is working. I mean, it absorbed three of the largest banks to have collapsed in the United States in history. And so if the system can tolerate that level of stress, then arguably it is working, maybe not as intended, but in a way that is functional. Financial crises really need to break bad before lawmakers start to think about broad-scale reform. Even with the 2007-2008 global financial crisis, Dodd-Frank was not a given. It came close to not making it across the finish line. And I think in one iteration, when you're talking about things like TARP and other like sort of emergency measures, those did not pass on their first go-around. They had to go again. And so nothing in financial services legislation is a given whenever the system begins to bend and even break. It takes a lot of political will, even when you had the margins of the Obama administration when it came to Democratic control of Congress. So it's really tough to say.
That's fascinating, and it's still interesting to see that even after all these months, still not able to get lawmakers on the same page about what to actually do with this reform. Fantastic breakdown there for us. Punchbowl News financial services reporter and author of The Vault Punchbowl News new newsletter, Brandon Pedersen. Thank you so much. Have a great weekend.
Thank you.